Good evening, traders and investors. Will back here with another one, coming to you with a Friday market recap. Hopefully you guys had a very nice day in the markets on Friday, and hopefully you are off to a very nice start to the weekend as well. In terms of Friday's action, we had a beautiful day in the markets, which actually saw the S&P hit a brand new record all-time high throughout the day, but we also had some very nice performance from the entire rest of the market. All major sectors performing well, all major sectors ending in the green towards the end of the day. As a matter of fact as well, we had some of the best market breadth and overall broad market momentum that we've seen in quite some time. The percentage of stocks above their 20-day moving average, the short-term momentum gauge of the market, is now at 75%. So 75% of all companies are trading above their short-term moving averages. Those are numbers that we hit earlier in the month of July and even in May when the market was doing really well and when concentration was not a risk that people were talking about. The percentage of stocks above their 50-day, their medium-term moving average, is also quite good, curling up higher right now at about 68%, also going against some of the concentration risks that people have been talking about in the last 2-3 weeks. And lastly, the biggest of them all, the longer dated momentum moving average, the percentage of stocks above their 200-day EMA, that is now at 61%. So 61% of all companies now trading above their longer term moving average, which, as a matter of fact, is the best breadth in the entire market that we've had all year. As a matter of fact, better than we had in the month of February, much better, which was only high 50s, coming to rival the markets that we had last December and last November. So you can clearly see that whatever happened on Friday, it resulted to a very nice broad market event. And in terms of whatever happened, well, of course, you guys know exactly what happened, and that was indeed what transpired at the Jackson Hole event, whereby Jerome Powell hinted at possibly needing to cut rates. Here we go. The Fed may need to cut rates, but will proceed carefully. Now, of course, the discussion was about the balance of risks. The Fed has two major mandates. Number one, of course, is protecting full employment of the jobs market. Risk number two is inflation. So it's always the dual mandate, and they have to kind of thread the needle between those two things. Now, the crux of the argument was to be whether or not Jerome Powell thought that the risks were more towards the labor market or more towards the inflation side of things. Obviously, if the risks are more towards the inflation side of things, you would tend to keep rates higher for longer. However, if you see some near-term risks to the labor market, that is a point in favor of some rate cuts. And essentially, if you read between the lines of Jerome Powell's speech, the risks are more indeed now towards the labor market, and as a result, to prevent the erosion of the labor market, the Fed may need to have to cut rates, even though they would like to keep them high because of the tariff threats on the near-term horizon. However, those tariff threats may just be a one-off. That was the takeaway from Jerome Powell's speech. In today's video, guys, we're going to do a few key things together. Number one, we'll be doing a quick summary of what was said on Friday and how it impacted the markets as a result. Number two, we will be going through our technical analysis rundown of all our major sectors, determine which sectors are currently leading in the rally, which sectors are currently lagging, and where our money would be best suited. Moving on, after that, we will be taking a look at our big tech list, where we will derive the same things. Are there still any very nice short-term swing trade opportunities on some of these big tech names? And or are there some very nice long-term portfolio buys across these names as well? After that, we will get into not the biggest gainers and losers of the section, no, because the entire market was green. So covering this section would be a bit redundant. We covered a lot of this section all throughout the week, and you guys know where I stand on some of the high-flying growth names. What I figure I should show you guys instead in today's video is about 15 stocks that I've compiled that could do very well coming into a rate-cutting environment. Some are going to be possibly for long-term portfolio additions, and some other ones are thematic plays. What names could benefit from tremendous rallies into the next 3, 6, 12 months as a byproduct of those rate cuts? After we are done that section, we will cap it all off with a view into my portfolio for the trades that I made this week and also which positions I'm keeping into next week as well. So without further ado, guys, let's jump right into it, shall we? So the SPY up 1.54, the Q's up 1.54% as well. Identical performance across those two names. In terms of the heat map, you will see that it was a very broad market, as we were currently previously describing in the momentum analysis. The only little names that were left behind, well, they're not so little, but the only little sector that was left behind is consumer defensives. Everything else really green, guys. Big tech had a fantastic day. Semiconductors, software, very strong performance there. Financials, of course, one of the biggest recipients of, those rate cuts, essentially, as it will improve their net interest income and their bottom line profit margins. They were substantially higher on the day. Healthcare even getting a lot of love through the day. And the bottom half of the market, which is known to be the more rate sensitive aspect of the market, everything from industrials, real estate, utilities, and other things, also benefiting tremendously from Friday's news. In terms of the one-day relative, you'll see that even better. Most of all your major sectors ending higher on the day. Consumer defensives a little bit flat because Walmart and Costco came down. And on the 1 week relative, we have now unwound a lot of the pain that was seen in the markets earlier this week. Most of all your major sectors were moving higher, but surprisingly, communication services and technology, they dipped really, really hard. So even Friday's action was not enough to undo some of the pain that was felt earlier this week. This is the 1 week relative performance here. You can see that most of all your major tech names are still in the red on a 1 week relative performance, but they're doing substantially better than they were on Tuesday and Wednesday. So before we get into more technical analysis, let us do a quick summary of what happened in the meeting in Jackson Hole. So moving on to the article right here, here's what Powell had to say. The stability of the unemployment rate and other labor market measures allow us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. So once again, talking about the fact that they're not too happy with what they're seeing in the labor market, and they may want to get ahead of any weakening in that aspect. Moving on further, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly. So once again, if you read between the lines, they don't want that to happen. And what's the easiest way to prevent that from happening? Possibly cutting rates. Fed Powell also noted that while tariffs are expected to drive prices higher, the baseline case is for their impact on inflation to fade, hinting at the fact that it may just be a slight adjustment period, that these tariffs are not going to lead to long-lasting structural inflation, but that you can see a quick uptick here, maybe over the course of the next 3-4 months, but that it would fade thereafter. Moving on further, you can see that when Powell said these comments, the rate cut probabilities as gauged by the market are now back to about 85% for a rate cut in the month of September. So although Powell did not explicitly say that the Fed was going to cut interest rates in September, his comments about the shifting of the balance of risks definitely did hint at that. Moving on further, this is what one analyst took from the whole meeting, basically paraphrasing what Powell was saying. It looks now likely that the impacts on tariffs will be more of a one-off. I do think the labor market is slowing, however. Policy has been quite restrictive for quite some time. So maybe hinting at the fact that policy has been, the interest rates have been so high for so long, it is starting to impact the economy. So before it starts to impact the economy too much, it might just be the time to ease up a little bit on the interest rates right now. Those were the main takeaways from the Powell speech, and reiterate exactly what I was saying on the channel as well. In the past month, we've been pretty much saying the exact same thing, that the balance of risks was indeed shifting, and I was largely expecting the Federal Reserve members to start acknowledging that, so it's nice to see that the thesis is finally starting to come together. So, that being said, let us jump into the technical analysis portion of the video, and you guys will see that although we had a very nasty slide early on the week with a nice pop into Friday, not much has changed in terms of who is in control of these charts. In terms of the SPY, we've always had a very nice daily uptrend. We were getting a little bit cautious here as we lost the short-term moving averages, and we were saying, well, listen, if the day on Friday was bad and you give back too much, it really opens up the door for some extended consolidation. And what better period of time than the fall seasonality period to go into consolidation. I'll remind you, if the Powell speech had a negative tone, if he was very firm and very hawkish on not wanting to cut rates at all and still being data dependent, the market probably would have not taken that too well, and we probably would have slid. Thereafter, you don't really have much positive news to look forward to until that September meeting. The next CPI release is still 3 weeks away. The next release on the major jobs release is also about 3 weeks away. So we would have had a bit of a dead zone in the markets for the next 3 weeks as the markets get a bit more apprehensive coming into that data without being kind of guaranteed a rate cut. So that probably would have resulted in somewhat of an extended slide. But now what you have is the markets are pricing in that capacity for a rate cut right away, which is why you're seeing all sectors of the market rally higher and not just a few key names such as big tech, which have been a defensive area of the market recently, if you can believe it, right? Their growth, but they've also been somewhat defensive because big tech has very large cash flows, very good margins, and very nice forward guidance, right? So the SPY is currently still in a very nice daily uptrend. The higher lows are now set at 633. So watch this. This now becomes your line in the sand level. If somehow over the next week we undo this entire move, you are going into what we were describing previously, which is just very healthy weekly consolidation. If that doesn't happen, of course, well, you are going to move on to new all-time highs, and the next psychological target for the S&P, of course, has to be that 650 psychological flat round number. So the bulls still looking good. The biggest takeaway from the S&P, in my opinion, in terms of price action, is the sheer amount of sectors that are now participating. We have very nice breadth, and when you have very nice breadth in the market, guys, that's not retail. That's the big money. That's institutions starting to even bid up a few sectors that have been notoriously lagging behind for essentially the past 6 months, even 12 months. Moving on to the QQQs right now. Same context, but the bounce is just not as large just yet. The line in the sand level is now set at 559. We were noticing that although the bulls still had the very nice daily uptrend, they had retraced a large portion of those gains. This was now a 618 down to 782 retracement. And when that happens and the news cycle is not so favorable, you can indeed expect a slide, a daily downtrend, and erosion of the weekly time frame into, once again, healthy, in my opinion, consolidation. Now, of course, with the Fed's comments, that has indeed shifted the balance of everything as the market is now going to price in rate cuts. And as a result, the growth stocks are probably going to do very well. So we would be looking for expansion back to the all-time highs right here of about 582. But the line in the sand remains. If for whatever which reason you crack those lows, you will go into weekly consolidation. And thereafter, guys, if we flush even more through the late stages of August into early September, I've been very firm in saying the easiest area to predict where the market would possibly come down into a support zone would be previous all-time high resistance, current new support, the monthly 12 EMA, which currently stands at 538 down to about 511. So I am ready either way. You guys know me. I still have a ton of positions long, a lot of leap call options, but also what I do on a week-to-week basis is sell puts in the market. So I don't care either way. If the market keeps ripping higher, I'll be able to find some names to sell short puts on, and I'll just be riding my long-term portfolio full of very high-quality stocks and riding a lot of my leap call options. If we come down for a very logical and healthy downswing, well, of course, I will have more opportunities for possibly short puts using the wheel strategy and possibly more opportunities to load up on even more leap call options, which I will be carrying through 2026 and early 2027. Moving on to XLF financials right now, very solid day for financials, brand new all-time high. So cracking through the former all-time highs, and the bulls retain control of this daily uptrend. The line in the sand daily higher lows are set at 52.29. So at this point, any move lower, looking for a new higher low for possible further trend continuation. Financials should be getting a lot of love, and my favorite plays in financials still remain Visa. Visa has been notoriously lagging behind the S&P, down not every day for the past 3 months, but clearly a divergence from the SPY. Still a very nice opportunity to build some further positions in our long-term portfolios. And Berkshire still remains a favored swing trade for me. Very nice bounce out of our whole support area, also trailing the markets for the past 3.5 months, and might just be looking for a very nice upswing, as we know that every time Berkshire comes down into this 12-monthly EMA, it has been a very decent area to accumulate some positions, and then the market usually does favor rewarding us to the upside. So financials, not looking too bad at all, just looking to continue the weekly leg higher. Moving on to healthcare right now. Healthcare doing something, finally cracking above our infamous 137 area, the area that's been holding back the markets since the early stages of May. Looking quite good, I might add. We have a weekly breakout on healthcare right now, and this entire area that we just broke out of will now be acting as a support range in the event we do pull back into it. So healthcare, you might think that you're late, but in all reality, when in doubt, zoom out, guys. You are still within the range, within the confines of accumulation. You're starting to break out, but now is kind of like last chance to dance, right? If we do pull back a little bit more, or even if we stay right here, I think it is a decent time to be loading up on some either XLV leaps overall, such as the ones that I have for 2027, or if you're looking to individual names that have been left behind, individual names with high quality business models such as NVO or UNH, if you guys are willing to give these names a chance, possibly for holds over the next 6, 12, 18 months, not a very bad proposition. I'm not saying load up on weekly call options because they're going to fly, but any longer dated positions, just benefiting from the fact that a lot of these companies are now in deep value territory, can have a good chance of being rewarded here as we embark on possibly a monthly upswing for healthcare. Moving on to SMH semiconductors right now. Semiconductors with a very good day on the Friday session, but still, we did lose the daily uptrend, and it may take a little bit of work to get back. But keep in mind, this is going to be a very interesting week. Why for semiconductors? Well, because we have NVIDIA earnings on the Wednesday session after the close. They are the juggernaut in semiconductors, and whatever happens in that earnings will move this sector in a very big fashion. If NVIDIA earnings are very good and the stock moves up 7-8%, the expected move for the stock this week by Friday is about 6%. So obviously, if they carry the index higher, we are going to brand new all-time highs. In the event that NVIDIA earnings are not well received, which would be surprising, but crazier things have happened this earnings season so far, we'd be looking for a daily downtrend, a very healthy continuation of a weekly consolidation move. And if you take a look at the longest timeframes of them all, that would just be a very healthy monthly higher low. Another index that you can look at is the SOXX. We currently have very large support below us, 236 down to about 213. Any back tests into this region on your favorite names could be a great opportunity to possibly load up some more swing trade longs. Talking about Micron in its own support area, starting around the 110 area. Talking about ASML, which has been notoriously weak for a better part of the last 1 year. Decent location to accumulate some long-term share positions. In the event NVIDIA comes down and drops, back down somehow into the 150s, that'll be a great buying opportunity. And even something like an AMD, if they also drop a level after NVIDIA, not too bad of an opportunity to accumulate into the 160s for some shares, and even a little bit lower as we embark into very simple and very healthy monthly consolidation on those names. So get together a list of your favorite semiconductors and be ready to play them either way this week. Now, one of the sectors that did the absolute best this week was, of course, the Russell. Growth names really coming alive, and this was the thesis that we had. The Russell responds the most to comments about the direction of interest rates and or direct interest rate cuts. So the Russell trying to front run the market, that was up 4% on the Friday section, and we are finally cracking through an infamous area of resistance that we haven't been able to get above since the month of January. But now the tone is shifting in terms of the rate cuts. So this is what I was waiting for to possibly position in the Russell. Am I saying weekly call options? No, but possibly some shares, because keep in mind, guys, the Russell, although cracking above the notorious area of resistance, and the Russell in a very nice weekly uptrend right now, is still not even close to its prior all-time highs, which we achieved earlier on in December of 24 and also in November of 2021. Essentially, what I'm saying is this ETF has not really done anything for the past 3-4 years because interest rates have been high, inflation has been high, and growth stocks really don't enjoy that type of environment to really start running and cascading and gaining the levels higher. However, now that we have confirmation possibly from the Fed, it could be a nice area to position for some longer duration swing trades. If I had to play this one myself, I would probably be going in with some leap call positions in the money leap calls. And in the event that we drop and fade a little bit from this move, it would be an accumulation period for some of those call options. If we are looking for very logical things to do here in terms of in the money leaps, if I had to price them out, keep in mind, of course, you're buying after the rally, but it's the context that matters. You are going for leap calls that should be dated 2027. You are going for the progressive expansion of growth throughout the next 6, 12, 18 months. You're not necessarily looking to buy here and sell it here really, really fast. No, this is a thematic trade that possibly will be playing out over the next 6, 12, 18 months. And as a result, even if we're not buying the best price here, if we slide and DCA into this position, it's kind of exactly like healthcare, right? You accumulate at the levels for the theme, and then once your position is built, then you are going to ride the position for a longer term future, right? If I had to price out some IWM leaps right now that I had to DCA into, I'd probably going with a June 2027, and I'd probably be favoring something in the 70 delta range type of thing, right? 70 all the way up to 80 delta, depending on your budget, are providing some very decent risk to reward trade-offs if your thesis is for the continued expansion of this sector for the next 6, 12, 18 months. So please keep that in mind. Moving on to the VIX was down 14.35% because what the Fed said, or what Powell said rather, definitely removes a lot of uncertainty in the markets that we've been feeling over the past few days. And now we are currently coming down into our level right here. So you guys know the drill. When volatility is very low, that is a time to buy leap call options, right, on some of your favorite stocks that maybe have been left behind. We're not talking about stocks that are currently still clipping their all-time highs at overpriced valuations. No, we want to be looking for things that have been left behind, things with low volatility in a low volatility VIX environment. That is how I play the VIX overall, keeping that in mind. Moving on to yields right now. Yields had a very nice drop. We will see if they're able to continue the push. As I've been saying, unless we get a break of 4.2 on the 10 and a break of 4.7 on the 20, we can't really say that a longer duration downswing in yields is finally starting. We will see if that's going to be the case over the next 1 month. And as a result, we will see if the bond trade finally gets some lift. But now that we get closer and closer to the infamous rate cutting cycle, it is kind of the last chance possibly to DCA if bonds are your style of trade. But keep in mind, you need to be putting a lot of time on this trade if you're using options. 2027, because this one moves slow. It's not Palantir. It's going to be a slow and methodical rally as we move through the rate cutting cycle, provided that the economy doesn't fall off a cliff, of course. Moving into our gold trade right now. So gold up about 1% on the Friday session, testing the top end of the range right here, 34.05 down to 33.65. What I like to see on gold right here is my infamous breakout and retest trade. It's very tough to buy into resistance right here, although we do have a bullish leaning bias because the bulls have given us a very nice tightening range over the course of the past 3-4 months. You could call this a bull flag, and I probably would agree as well. The stop loss for a long here, if you don't want to wait for the infamous breakout, retest, and run trade, if you are positioning here, keep in mind the stop loss needs to be down below here, 32.65, because if you lose this, you lose the weekly uptrend and you would head into simple monthly consolidation. It would be very healthy because gold is very overbought on the monthly timeframes, extended from the 12 EMA as well. So please make sure if you are trading gold, you're trading it with a stop loss, as if it unwinds, it can unwind pretty quickly, and the level below us is quite deep around that $3,000 mark. But gold is not looking too bad. Shorter term swing trades might just want to establish the short-term price action confirmation that they really want to capture the level. Give me the breakout, give me the retest. If we get the retest, the stop loss goes below the lows, goes below the resistance range, and then we are looking for expansion towards 35 with a tighter stop loss for a shorter term directional trade. Moving on to Bitcoin right now. Bitcoin had a fantastic day on the Friday session. Ethereum did as well, and so did all of crypto, of course, because it's a risk-on trade. However, you can see that resistance, unfortunately, has been plaguing the bulls on this Saturday session. 120 down to about 117 is the resistance range. They held this range for a while. They broke below it. You can see they were challenged with it prior, and now we are being challenged with it again. So daily downtrend, the bulls have a nice move, but they need to convert and smash through this resistance area. Some of the clearest timeframes, in my opinion, are the weekly. This is just a very nice weekly tightening range. It's a wide range, but a range where at somewhat of the top 30% of this entire weekly leg higher. So in terms of Bitcoin, it is an accumulation trade as well. For some of you that are looking for a longer term breakout with a wider take profit range into the 130, 140, 150 range overall, fantastic area to be accumulating, whether it's here all the way down to our prior support level, which is about 110 down to 101. This entire range, if we break down there a little bit more, guys, Higher time frames hold the key in my opinion. You'd just be looking for a monthly higher low into prior all-time high resistance, which will now be support for the possible extension of the longs, right? These are looking for the big longs essentially, right? Not the short-term swing trades from here back to the all-time highs. No, if you're looking for the bigger duration longs, you can be playing that in terms of the overall expansion trade. And the trade that I'm using to do that is MSTR. Why MSTR? Well, because MSTR has a very low MNAV right now. Let me just pull it up for you guys so you guys can see. The MSTR MNAV right now is a 1.6. Traditionally, this one trades around a 2. If you don't know what the MNAV is, it's very simple. It's the amount of Bitcoin that they hold expressed in dollar values and then versus their market cap. So essentially, it is the market cap of MSTR divided by the total value of their Bitcoin holdings. Traditionally, it's closer to 1.6. And if you want me to show you the historical average of this MSTR MNAV history, I'll pull up this chart. Sorry, it was blurry the last time that I did this. Hopefully this time it'll be a bit clearer. It should be this time. You can see here that the whenever it does fall down below 2 type of thing, especially down to 1.5, 1.6, this is the lower bound of where MSTR usually trades. So you can say that MSTR is somewhat undervalued in 2 respects. Number 1, in relation to its own MNAV, but number 2, also if you believe that Bitcoin is also moving a lot higher, well then MSTR would be undervalued in terms of your opinion on the value of Bitcoin moving into the future. So the trade that I'm using for Bitcoin expansion is indeed MSTR. I've been accumulating some positions in the lower areas down here. It could be a very juicy trade moving forward, so please keep that in mind. Moving on to Ethereum. Ethereum had a very fantastic day on the Friday session, up 14%, retracing a little bit of those gains today. We were monitoring how far the bears would pull back and would they actually clip into the 4,000 to 3,700 range. They did not exactly clip into it before setting this massive expansion. Very tough to catch this move on the Friday session unless you literally just indiscriminately bought after the rise, but you can see after the first hour, it kind of peaked out and now it's just been kind of flatlining right here. If you feel that you have missed out on Ethereum so far, the best thing that you can do, guys, is not go full YOLO right here, is to embark on a DCA process, the same DCA process that I was describing here, whereas you build a position for some of those weekly pullbacks. I'm not saying it's going to give you a pullback opportunity again, but also chasing trades like this, guys, I mean, let's be honest. You're late if you have a short-term time horizon. However, if your view is in line with what Tom Lee and other people say, especially with the stablecoin narrative, whereby Ethereum, the price of Ethereum could go all the way to $10,000 at some point over the next 2 years, then as well, you would be kind of early. So you would be building some positions slowly but surely and not so much focusing on super short-term call options in terms of weekly or bi-weekly plays. No, any longer duration options, guys, if you guys are using ETH-E or maybe ETH-A as a type of proxy, or even BMNR, which is kind of Tom Lee's version of MicroStrategy. It's a bit different, but you know, it's in the common theme, right? It's just a treasury of Ethereum that trades at a higher multiple, right, than it necessarily should, kind of like we just saw the MNAV for MicroStrategy. Decent area to accumulate if you're possibly trying to hold for something like a longer duration 2x. But as with everything, guys, don't go too heavy. Don't make it your entire portfolio. That's everything for the overall market rundown. Hopefully you guys appreciated that. Now let's move into our big tech name list, shall we? So first, as we always do, moving into Apple. Apple was up 1.27% on the day, not looking too bad. Now we know the problems that Apple has been facing recently, the slower than expected AI rollout, and obviously the problem with the slowing of the revenue growth rate. However, last earnings kind of turned that all around. 10% year-over-year revenue growth, the best quarter since December of 2021. And also, they are possibly exploring acquiring some AI players to help them with the rollout of AI as well. If there's one thing that Apple has, of course, is a tremendous cash pile. So if they have to buy their way to AI dominance, essentially, they will probably do it. Now, there's a few reasons why I'm excited for Apple. Number one is the iPhone 17 rollout, which will be coming in September. And number two, there's a slight portion of this that also comes with rate cuts. Of course, Apple doesn't make the cheapest products, and oftentimes people do take financing plans to pay for consumer discretionary items. So consumer discretionary items, which have been notoriously weak for the better part of the last 2-3 years, may be starting to see a rebound into 2026 as rate cuts start to hit the markets, as the effect of the Trump tax cuts with the big beautiful bill also potentially start impacting the markets as well, and the iPhone 17, which is a far better product than the 14, 15, and iPhone 16s as well. So essentially, all of those things lead me to be a bit more bullish on Apple for the next 6 to 12 months than I have been on Apple in the past 6 to 12 months. So essentially what I'm saying is longer duration trades may do quite well on this stock. That being said, in terms of our price action in the short term, anything above 201.41 was still looking for a daily higher low. Now, the bulls did crack above our resistance range, which was at 232, and now we're kind of pulling back into it, using that as current support. It's a very big level. You can see Apple has been challenged in this area before, support, and obviously the bottom end of this was resistance for a long time. We've now cracked above, so any pullbacks in Apple, I do think are a great dollar cost average opportunity if we're playing shares, and maybe even some leap call options. You guys know me. I bought leap call options back here. There was another opportunity to DCA those down there. Right now, if you're asking me, is it too late? It all depends on your time horizon. If we're targeting 2027 leap call options, then probably not, as Apple will start moving through possibly that iPhone refresh cycle, the consumer discretionary cycle as well, and also benefiting from those lower interest rates too. All of those things are not immediate impacts on Apple, so you really need to wait for the fundamentals to be shown on the company. But the longer term expansion of the business, I think, can probably do quite well, at least better than it has been doing in roughly the last 1 year's worth of time. So I am a fan of bidding Apple here. Moving on to AMD right now. So AMD up 2.47%. Very strong day for AMD, but still kind of trapped in our support range, which is 171 down to about 156. They had the daily uptrend, they lost the daily uptrend, and now we are just in a larger form weekly consolidation. You can say that there's 2 times that the bears tried to challenge this area, and both times they got rejected for different reasons. Number 1, people bought up the earnings release, and number 2, well, people bought up the day on the Friday session as well. So very nice support, and this is a fairly decent area for AMD. It is, in my opinion, an accumulation zone for shares if you're looking to play the expansion thesis of AMD over the next few years, which is essentially a more than doubling of their EPS, a more than doubling of their revenue pipeline, as well as they currently are embarking on their NVIDIA moment, basically scaling their offerings for data centers and coming into their pricing power, which should also improve margins. So decent first chance for a DCA, and if it does break a little bit lower to the next area, as I was saying in the introductions when we covered the ETF, SMH, I was saying that any dips on AMD could be very decent buying opportunities. Number 1, DCA area here, and number 2, down here overall. AMD still looking good around 170. The valuation is still very manageable considering their outstanding growth rates for the future. Moving on to Amazon. Amazon up 3.1% on the Friday session. The bulls saving the day right here. It was a nice daily uptrend. They had their lows challenged here, and we were saying watch the line in the sand level. Line in the sand level was 219. The bulls did a great job of protecting that, and maybe we might just be looking to further the expansion of the daily uptrend. The bulls also playing very nice defense in our prior area here, prior big area of price action, which is support. We broke above it, back tested it, and now might be looking a little bit higher. Amazon is still one of my favorite bets in the market, at least over the next 2-3 years. I'm holding these shares forever, guys, but in terms of at 220, is it a good deal? I still think so. I mean, you're not getting the best price as we got back here, but you're still getting a very fair price for this company. Now, keep in mind as well, Amazon has been lagging the market, kind of like Apple, right? If we look at the year-to-date performance, many of the big tech players are up 20, 30+%. Apple, Amazon, and Google are kind of the 3 companies that have been lagging behind, and I do expect there to be a bit of a catch-up trade here still. So although we are close to all-time highs, I still do believe it's a great buying opportunity for Amazon. And if we pull back more, you guys know exactly what I'll be doing. I'll be trying to sell some put options under the lows right there. On to Google right now. Google was up 3% on the Friday session, as high as 4% intraday, but a very nice close for Google stock. Now, that being said, we currently lost the daily uptrend coming into the midpoint of last week, and now the bulls were able to V-shape this in one single day. However, they did not close above the area of resistance, 207 down to 202. So in the event it continues being choppy, which it has been the last 2-3 weeks, the bulls have kind of struggled with this area. If they do struggle a bit more and we break down a little bit, you guys know what I'll be doing. I'll be selling put options down here in the mid 190 range, which is the next fallback area of support, talking about 195 down to about 186. Prior highs prior lows of support right there before we flushed with the tariffs, that would be the logical fallback area and would just be looking for the bulls to establish a bit of a weekly higher low before a next leg higher. The next swing trade attempt for Google, in my opinion, is the breakout retest. If you get the breakout and the retest of this range, easy stop loss territory. It would go below the lows of, let's say, last Wednesday, and then you would be targeting expansion beyond the all-time highs, which currently stand at, well, I mean, we just did hit new all-time highs, so I guess you'd have to go with psychological. Sorry, my bad. 215, 220, so the risk reward wouldn't be too bad for Google overall. Do I still think Google is a decent buy around these locations? As a matter of fact, I do, and it comes into what we were saying, right? Google is still lagging year to date, but not only that, they're also lagging in terms of valuation. It's currently about 10% higher than when we did it at 190, but that would put them at a low 20s forward price to earnings and still a very low PEG ratio, all things considered, with some fantastic growth rates still forward for this company. So I'm still a big fan of adding and nibbling some Google shares. Obviously, I'm not going all in here on Google. That should have been done back here when we were talking about it at the channel. But will I still DCA even to the upside? Yes, because I think this company is still undervalued in relation to where I think it'll be by end of 2026, which is probably $250, $260, $270 per share. Moving on to Meta right now. Meta up 2.12%. Meta recovering a little bit of the damage that was done midway through the week last week. That being said, we are still at a loss of a trend right now on the daily. The higher lows were here. Sadly, we flushed them, but where do we come down to? We came down to a very key level, guys. Previous resistance, and that on the weekly time frame is very clear support. And the weekly bulls have never lost this chart at all in the last 3-4 months. We were always looking for a weekly higher low, and I was saying that if you come down here into the 730 range, or maybe even a bit lower back to the low 700s, it's a decent time to be adding shares on Meta. The valuation, in my opinion, is still not egregiously expensive at 760. Sure, it's above a 2 peg. It is slightly under a forward price to earnings of 30. The company is still doing fantastic, has phenomenal net margins as well, and will be growing really nicely into the next 2-3 years of trade. So it's not a full send YOLO at these current levels, but would I be DCAing if I have positions on Meta? Would I still be DCAing with every paycheck into this company until it gets expensive? The answer indeed would be yes. Swing trades here can be possible, but you'd have to keep a tight stop below the lows of last week, because what you're going for here is you're trying to assume that the bulls will recapture the daily uptrend and will lead into more weekly uptrend continuation. So this one can be done with a very tight stop loss below the lows here at about 730. And the first target expansion would be just above the all-time highs, 800 psychological. Moving on to Microsoft right now. Microsoft still in a daily downtrend and still below its EMAs. This is the first time that Microsoft has lost the 12 EMA and the 26 EMA for that matter in the better part of the last 4 months. So it has to be notable to us. The entire time that we are in a daily downtrend, we're expecting lower highs into lower lows. That is until the bulls choose to reverse this trend. Only when you see a brand new daily uptrend on Microsoft can you say, yes, the higher lows are set, and we might just be looking for a next leg of upside on Microsoft. But until the time that I get a daily uptrend shift on Microsoft, I can't really go for a swing trade long at all, right? That's the unfortunate portion of it, because sadly, it is currently a nice daily downtrend into weekly consolidation. That being said, am I buying more Microsoft shares here? No, I bought all the Microsoft shares that I wanted to at the lows here, at the tariff lows, and I really haven't added to the position ever since because it is at the top end of Microsoft's historical valuation. That being said, am I selling any shares? Definitely not. Microsoft is a long-term hold company for me, so although the valuation is rich on it, it is still just a hold. No swing trades at this current time. Moving on to Netflix right now. Netflix actually red on the day on Friday, but still not cracking below the lows that the bulls have been trying to protect. This whole support area is 1215 down to about 1185. So they're trying their best to hold this, not lose the daily lows, and go for continuation of the expansion. Why is that important? Well, because similar like Microsoft, they had lost the uptrend after 3 months and also lost this infamous 12 EMA, which is your short-term momentum. So the bulls are trying to do what you should be looking for on Microsoft right now, actually, which is trying to reestablish a daily uptrend and trying to put in a decent-sized bounce in terms of this weekly. Because here on Netflix, contrary to Microsoft, which hasn't lost the weekly, Netflix did. So now they need to get it back. So it's a very tricky situation for Netflix. If we had to do swing trades, we would have to do so with a very tight stop. The stop would be below 1180, and we'd be going for expansion, possibly all the way back to our highs, going for the weekly leg of expansion on Netflix with a very tight stop loss. The reason why we keep a tight stop loss is because if it breaks down below there, probably heading down to the lower bound of support, 1150 to 1113, and that would just show us that weekly consolidation might not be finished and monthly consolidation might not be finished either, which is why if we do trade this one, we trade it with a tight stop. Am I buying more Netflix shares up here at 1200? No, not really. The last time that I bought some Netflix shares was down here under 1,000. And if we do come to the 1,050 level again, I will be adding. I'm pretty much full right now, but the valuation is a little bit high. However, if you have a 5-year time horizon, and this is your first time exploring buying Netflix, we'll just go with management's valuation estimate. They say they will be a $1 trillion company by 2030. The company's market cap currently is $500. So if you wanted to start a Netflix position here, and then maybe DCA with paychecks, right? As it kind of moves lower into the levels, if it does happen, not bad. Over the next 5 years, you might just be looking at a 2x, which is a pretty good annual growth rate, all things considered. Moving on to NVIDIA right now, NVIDIA up 1.72%, but probably the short-term price action on NVIDIA doesn't matter. Why? Well, because they have earnings, of course, this week, and the expected move is about 6%. Now, in the event they move 6% higher from here, obviously we'll be looking at a new all-time high of about 190, and then your psychological target will indeed be $200. In the event we move 6% lower, well, watch out. That'll be a daily downtrend. It'll be very healthy weekly consolidation, and you will definitely find me being a buyer of NVIDIA if that does happen in two different fashions. I might just be looking to accumulate some shares of the company as we move into support range lows, which would be the low 150s as we can see here, right? Or also selling some put options. If you get a very nice big drop, similar to what AMD had after their earnings, it'll be a perfect time to sell some put options down there. Because if you want to buy some shares down there and you get assigned, perfect. You end up with shares exactly where you wanted them. If you don't, if it doesn't assign you, perfect. You get to collect the very juicy premium. At 170, NVIDIA's valuation is it's up there, but it's not crazy. It's currently trading at a 1.7 peg. Not bad, not good enough for me to start a brand new full-size share position, but if you do come back down into the 150s, I might just consider a larger trade, maybe with some leap call options or something like that. Moving on to Tesla right now, Tesla up 6.22%. And when you think about rate cuts, guys, you have to think about Tesla because Tesla, despite the fact that everybody focuses on the long-term positives, you also have to assume that the short-term negatives have been plaguing the company a lot in the most recent 6 to 12 months because it's an auto manufacturer. And we know that all across the board, OEM auto manufacturers have not been having the best time in the last 3 years, as financing and lease rates still remain high unless they're subsidized by the manufacturer, which a lot of companies are doing, but still, the car business is not as hot as it was, obviously, back in 2020 and 2021. That being said, Tesla had pretty much a picture-perfect time here, but if you would have taken this trade on Thursday, you would have essentially gone all in on the Federal Reserve, or rather on Jerome Powell's speech on the Friday session. So it was a bit tough, guys. The technicals were very solid. Since we had this tightening range right here, usually when you break it to the upside and you backtest the channel, it can be a technical long, a very beautiful technical long for the most part. However, we had Powell, so I do not blame anybody if you guys did not want to position. It was a very tough trade. You pretty much just had to take the trade and cross your fingers that Jerome Powell was going to be nice to us, because if he wasn't, for sure we were going to break down below and head into support. That's just how sometimes the game is played. Right now, the stock is moving into resistance, 340 to 360. However, with the proposition of rate cuts and now the technical pattern playing out, you can see the possibility for expansion, but you would be assuming that they will be able to break through this resistance range. If we need to take a short-term swing trade on Tesla, the stop loss would be down below here, below 313. We would be assuming that with the momentum and with rate cuts, that more bullish momentum will pour into Tesla, and they might possibly smash through this one and get to this one next, which would be a weekly continuation trade. So you can keep a very tight stop loss here. The stop loss would be about $25 to the downside, and the upside profit target would be about 380 all the way up to about 400. That is not terrible in terms of risk to reward, guys, right? If you take a look at the risk reward profile, it would be just about a 2-to-1 risk to reward, going for the longer time frame expansion here, the weekly uptrend expansion of the business, moving higher than this resistance range, which has been plaguing the bulls for a better part of the last 4 or 5 months, and going for one range higher around 400. Not a bad swing trade opportunity in my humble opinion. Just make sure that you do keep a stop loss, because if you breach that, we are just going to revisit the support range and may just hesitate here for the short period of time. Moving on to Palantir right now. On a day like Friday, where everything was up multiple percentage points, you might be slightly disappointed that Palantir was only up 1.64. However, they did come down 25% from the top to the bottom, and you may just be looking for the bulls to accumulate some positions, right? So that being said, in terms of the uptrend or downtrend right now, well, we're at a loss of the trend. They flushed the lows, lost the daily uptrend, so now they have to get it back. If you take a look at the bounce size right now in relation to the size of the retracement, it's only about a 38.2% bounce. In the event that the bulls are not able to keep this beautiful 4-hour uptrend that was reset, and we unwind and just we figure that, they've only bounced about 38.2 on the fibs, well, the possibility of a rollover is quite pronounced. That being said, if the whole rest of the market continues bullish into next week because of the rate cuts, I would not expect Palantir to go contrary to the market. You probably would expect a continuation rally. And if the bulls are able to recapture 50, 60 to 60% of this move, then they are set up really nicely for the uptrend recapture. But if the market fades this move, I would expect more of a fade on Palantir. Essentially, what I'm saying is Palantir's price action at this point is probably going to be beholden to what the rest of the market is doing. So please keep that in mind. In terms of the weekly timeframes, Palantir is kind of just setting up for a new daily higher low. At this point, anything above 128 is looking for a brand new weekly higher low for further trend continuation. Some people could argue that there is some support here. If you don't see it much on the weekly, but you can see it on the daily, right? They did react from the whole 140 area a little bit. Of course, it's not as strong as a resistance or support area like this one down here, but it is something to look forward to. If you want my opinion, if you should buy Palantir up here, guys, I mean, you guys know the drill, right? Technicals are extremely overbought on the monthly time frame. The valuation is extremely overbought. The only argument that you would have for buying Palantir all the way up here is if you have a 5+ year time horizon and you're going for the expansion of the market cap, the expansion of the revenue stream, and you're looking for the fundamentals to catch up to the market cap eventually, similar to what Tesla did back in 2021, similar to what Amazon did for a good majority of its growth story from 2010 all the way through 2015, 16. So we have seen similar companies like this in the past. And if you believe that Palantir is a $500 billion company or a $600 billion company or a $1 trillion market cap company, then buying here would make sense. Anything under that, and of course the buys don't make much sense at all because the current valuation is very overblown. And if you're looking at the technicals as well, they're also very overblown. So maybe the best way you can do this, if you do have a 5-10 year time horizon on Palantir, you think that their products are amazing, which they are. Fantastic company, fantastic management, fantastic products, everything of that nature. Palantir is truly one of a kind. Everybody knows that, right? But maybe the best solution for you is just to, if you've taken profits up here and you want to DCA back into the position, down into the 140s, 120s, not the worst opportunity in terms of looking at it that way, right? It doesn't always have to be an all or nothing, guys, right? Like all in here or not, you can progressively DCA back into the position if you have a long duration time horizon. Moving into SOFI right now, SOFI up 7.24%. Obviously, being a fintech player with a rate cut on the horizon, they will do very well. The Bulls did a good job of playing defense, though. We were commenting on the fact that the Bulls, even after earnings, they did not lose this 2021 area. They've been playing some good defense. We had a short-term loss of the trend. The Bulls able to engulf the move right now, and finally closing above the infamous resistance zone, which is 24.5 down to 22.5. It's a big area, guys. This was the top end of the range for a good portion of time back in 2021. The Bulls are in full control right now. Beautiful second leg of weekly expansion. The weekly higher lows are still set at about 1993. And even if we retrace a little bit here, guys, this is when I start to get interested for the next leg of the rally. If you, now that you've cracked above it and closed above it, if you backtest this location, phenomenal area to maybe sell some puts or maybe build some further swing trade longs. If you're going for the expansion of the business over the next 3, 6, 9 months, it would not be crazy to see SOFI $30, $35, even $40. We're just looking for the expansion of the market cap. 40, 50 billion would not be so far-fetched for SOFI over the next year, 2-year type of time horizon. I'm not saying you guys are going to get it immediately, but it's looking pretty good to build some positions and just a buy and hold metric overall. Moving on to Uber right now. Uber up 2.72%. Fantastic day for Uber. And that being said, who controls the short-term timeframes? Well, it is still your bulls. Beautiful daily uptrend right now. Your higher lows are set 91.61. We have just recaptured this area, closing clearly above it on the weekly time frame. So everything is looking quite good on Uber. That being said, if we're looking for upside targets, you would probably have to target at this point $100 psychological for Uber, looking very solid. Tough to take a swing trade here for the breakout. If you did, the stop would be below this guy, because if you lose this guy, of course, guys, you unwind the entire move and you run the risk of just further weekly consolidation, which would not be so bad. However, if I'm looking to sell put options, the thesis is very clear, guys. It's a very nice weekly uptrend going for the expansion. If they get stopped out a little bit, our next area of support is down here, and I would be looking to sell puts in the low 90s or maybe even under the $90 range. If you're looking for this one for a long-term buy, it is not a bad bet at all at about $89. The valuation still made a lot of sense, and it does give a lot of room to the upside over the next 6, 12, 18 months. So I'm not a fan of starting a full position on Uber up here, but in the event that you already have some shares, it's definitely a hold and maybe even a little bit of an add, a type of a nibble trade, right? Moving on to TSM lastly, TSM up 2.49%, very decent day on Taiwan Semiconductors overall, but we know that the price action on this one has been very choppy. This is going to be affected by NVIDIA earnings on Wednesday, so please keep that in mind. Your line in the sand remains 224. If you get a breach of that, it's just a continuation of the daily downtrend and a very healthy further leg of consolidation on the weekly, which could send you back and retest the 220s. And if things really unwind here on TSM, well, of course, the very large and logical area of support would be down to 210, down to 200, which would just be a back test here of this beautiful area, prior all-time high resistance, and also current support and the 12 EMA right there. This would not look so bad for the stock, and this would be an area where we probably would be targeting some leap call options in the event that we are looking for some additions to a long-term portfolio in around the low 200 areas, guys. It is still very good. I know it's right now at 230, which is 10% higher, but it's currently still trading a low 20s forward multiple, a very low PEG ratio, and they have phenomenal growth for revenue and EPS. The past 2 quarters, the CEO has been saying, listen, we got so much demand, we cannot even keep up with it. So I do believe TSM will perform well and has been a very nice location to accumulate some positions. If we're looking for this being the absolute bottom and for some shorter term swing trades, you got to put a stop loss below the line in the sand. If you are trying to predict without confirmation of a daily uptrend, if you're trying to predict, no, that's the low, well, then you got to put a stop loss there and you would be targeting expansion beyond the 250 range. So best of luck on TSM. I'm a very happy shareholder for my long term, but I do not have any short term swing trades on the company right now. That is everything I had for you guys for the overall market rundown. Today, I tried to slow it down a little bit because I got a few comments that I talk too fast, and I know because there's a lot of information to fit in these videos. So let me know down below in the video description if you enjoy me slowing it down a little bit in terms of just in terms of like the speed of the delivery, right? Obviously, when I slow it down and I try to fit in the same amount of information, the videos may be a little bit longer than normal, but I'll still try to keep everything very concise and not tell you guys any information that you may just not need at all, right? Very concise information in the videos. So now that that's out of the way, let us dive into some names that I think might do very well with the upcoming rate cuts. I'll divide it into 3 sections for you guys. There's going to be about 15 different stocks, but we're only going to spend about 30 seconds on each. So let's get into it now. Okay, so first we're going to talk about some stocks that have a debt pipeline. I'll explain it in 2 different ways. These are either companies that have a lot of debt, that some of the concerns recently have been the debt on their balance sheet. Other companies in this list may benefit from rate cuts because their business relies on the repricing or refinancing of debt. So I call this section the debt pipeline. Company number 1 is going to be CoreWeave. So a big criticism of this company is how much debt that they possibly have to expand their business. CoreWeave and NBIS could be very interesting plays into the next 6 to 12 months. You guys already know that they're good companies in terms of the expansion of their business model, but the fact that they might be able to refinance that debt sooner than later is going to alleviate a lot of investor concerns for these ones. CoreWeave right now is currently trading at a very decent multiple if you consider the expansion of their sales come 2027. When we look at their earnings, I was forecasting possibly a share price, right, of north of about $300 by 2028. So this one represents some very decent risk to reward, but I know your concerns right now: insider selling, unfavorable sentiment. Yes, but that doesn't last forever, guys. The company is still priced for, the company still has some incredible growth ahead of it. Keep in mind that by 2028, instead of having $5 billion in sales in the pipeline, they'll be having $24 billion worth of sales, and they have about $32 billion of sales in remaining performance obligations. So the expansion of this sales pipeline is what I'm looking for, and the fact that interest rates are coming down may alleviate some of the pressure on this thesis. Same thing goes to be said with NBIS, where this company can probably, from its current market cap of about $16 billion, probably 2x over the course of maybe the next 12 months as they expand their offerings. Now, other companies in terms of the debt pipeline trade, we have to talk about SPGI and Moody's Corporation. Now, these are long-term bets. We're not talking about some very fast movers here, but they're very solid companies, ones that I do own in my long-term portfolio. And the thesis revolves around the debt refinancing pipeline that is due in 2026, 2027, and 2028. In the past 3 years, these companies have been somewhat muted. Although their share price has done well, a key component of their business is that they make a lot of money when other companies or governments or any other entity has to refinance, reprice debt in order to access the private debt markets. So these companies said on their most recent earnings that they have a tremendous amount of repricing of other people's debt in the pipeline, and they get paid money every time they have to issue a new credit rating and reprice people's debts. So Moody's Corporation and SPGI, I think, will be very, very big winners in the next 2-3 years, which is why I've been accumulating as many shares as I could recently in order to go for that longer term thesis. These are longer term plays, very consistent plays. They won't be the fastest movers, but you could be very decently rewarded for some very consistent companies overall. Moving into the next one, guys, we got to talk about FICO, right? FICO is all about credit scores. And as a result, recently, yes, they've had a tremendous rally because they were able to raise prices. And currently, their pricing power has come under the gun as there is a new competitor right now. Well, they're not new. They're just now a licensed model to use when people are looking to have their credit scores ran by financial institutions. There are two credit score models. Number one is FICO. Number two is the Vantage score. Who uses the Vantage score? Companies like Equifax, which is also a decent bet, but also companies like TransUnion, which also uses the Vantage score model. You can see that roughly, let's call it over the past year, these companies have unwound. TRU, TransUnion, Equifax in the past year has unwound as well. And FICO probably has unwound the most out of all of these companies since last year. I think that all three are decent bets. FICO is the one that has sold off the most, and we've been talking about it more and more at these lows. I think with the rate cuts coming, it's going to do very well. Customers will be wanting more in terms of mortgages, in terms of car financing, in terms of consumer discretionary items, such as furniture, such as electronics as well. So these companies could have a more accelerated revenue pipeline over the next 6, 12, 18 months. So if this is your style of company, you might want to have a look. And last but not least, of course, we talked about it before, but it's going to be the IWM Russell, which I did help you guys price out leaps earlier on in the channel, but there is arguably no bigger beneficiary from rate cuts in terms of the debt that they hold on their balance sheets than growth stocks. And if you're having problems identifying, individual growth stock names that you want to play, maybe you just end up playing the entire index. But as I said, guys, it's not a short-term play. You have to let the thesis expand probably through 2026 and early 2027, which is why if I had to buy leap call options on this ETF or shares, I would do so with a time horizon of the next 6, 12, 18 months, not necessarily the next 2 weeks type of thing. That is the debt pipeline portion of my favorite plays. Number two are rate-sensitive sectors. Some of the sectors of the market that have been a little bit left behind because, right, they get associated with high rates. High rates tend to lead to less demand for those products, but when you have interest rates coming down, it tends to lead to more demand for those products, of course. So some of the rate-sensitive plays, guys, we talked about it earlier, but I want you guys to also focus on Tesla. Now, I know that this is not everybody's cup of tea, but even for a small position going for rate cuts, because the long-term positives for Tesla, guys, have never been a question for most Tesla investors. Everybody's convinced that these long-term positives will be playing out in the next 5 to 10 years. But what has been under pressure recently is the short-term negatives. Slowing sales of growth worldwide. This is all car manufacturers. Price cuts and incentives because of that low demand, and brand perception, which, well, rate cuts are not going to solve, but still, these are the short-term negatives. A lot of this has to do with rates of financing. So keep Tesla on the watch list if you're looking for one car company, right, that requires financing that can move the quickest rather than trading Ford, GM, or other manufacturers. Maybe the fastest horse in the race just might be Tesla. So allocating a tiny portion of Tesla, if you've been waiting for this whole narrative, might not be the worst thing. Something else would be Rocket Mortgages. We've been talking about Rocket Mortgages for a long time, since down here, as a matter of fact, and I'm still a big fan of this company. Even though we've rallied a tremendous amount, accumulating some Rocket Mortgages on some dips is not that bad. They just acquired Redfin, and they are going through with their acquisition of Mr. Coop Mortgages as well. Now, I know the type of companies that have been making the rounds recently have been Fannie Mae and Freddie Mac. Shout out to them as well. But my favorite company of them all is definitely Rocket Mortgage, because they're definitely doing a good job of really consolidating the online mortgage space as the biggest player in the game right now. I would not be surprised if over the next 12, 18, 24 months, Rocket Mortgage can come back into the $25, $30 range. It's going to be not an extremely violent trade to the upside like you can see on Palantir sometimes, but it might just be something more of a sure thing than not with the expansion of interest rates. Other companies to look out for, guys, are going to be the buy now, pay later companies. Talking about Affirm or talking about another company, a newer player on the block, such as Sezzle. Now, Sezzle has come down a lot. The market cap currently is sitting about $3 billion. They are working on profitability right now, but they're expanding revenue very quickly. My personal favorite one is Affirm. We've been talking about it for a long time. We kind of front ran this thesis from down here. You might remember that I do have some Affirm call options that are currently up a lot of money right now. Affirm, these 110 calls were currently up 130%. But I do believe that if you have a longer duration time horizon, well, this is just kind of the start, right? The market was kind of waiting for confirmation. And you guys know when it's a question of low interest rate environments, these companies will do fairly well. Affirm does not hold the debt that they issue for buy now, pay later on their own balance sheet. They sell it to banks essentially, right? And it is one of the largest buy now, pay later platforms in the entire space right now. So any dips on Affirm could be a nice opportunity to accumulate some shares. Or in the event that you wanted to go for the, longer dated leap call options, you can do so, but always play these thematic plays very small, whether it's Affirm, whether it's Sezzle. Another company that might do well is Fiserv. A lot of these fintech players have been beaten down and beaten down and beaten down. Some have been beaten down for longer than others. Talking about PayPal, that one's been down for 3 years. Talking about Square, this one has also been down for a better part of the last 3 years. But the one with the best fundamentals, in my humble opinion, over and above PayPal, over and above Square, is Fiserv. Fiserv's valuation in around 140 is very cheap. They still have very good growth. And the back end of this company, guys, is extremely strong. They're very well integrated with the banking system overall, but they, similar to many other fintech plays, run on volume. So although they were able to protect their share price better than before, they did have a slowdown in their Clover platform, which led to a bit of re-rating to the downside. But now I do still think it's time for Fiserv. Accumulating down here through about 120 is probably not the worst opportunity in the world. Of all the fintech plays out there, shout out to PayPal, shout out to XYZ. I mean, we talked about SOFI. You guys know my opinion on SOFI. I'm very bullish on SOFI. But if I had to pick another one, it would probably be Fiserv. Then we can also talk about Visa, very logical play. This one has been left behind. We talked about it when we covered financials. Very logical play, guys. Tremendous network effects on this company, tremendous net margins. MasterCard has actually led the charge back to all-time highs. Which one has been lagging? Visa. Not a bad opportunity to add to a long-term portfolio, as this one has really been consolidating for a better part of the last 6-7 months. It is not so rate sensitive, but these tend to get bids in a low rate environment as well. So essentially, a lot of pressure being alleviated off of Visa's shoulders right now, as consumers might just be pumping more volume through those networks, especially utilizing their credit cards. And the last niche there, the rate sensitive, well, of course, was XHB and ITB, the home builders and home construction ETFs. Shout out to them individually, but also shout out to them as a group ETF play. We actually were talking about this play back here. You might believe that you're late, and that might be true if your reference point is the bottom and you have anchoring bias. But keep in mind, this one has been going down for a better part of the last 9 months. When you get an interest rate expansion interest rate declining cycle, aka a housing market expansion cycle, it can last more than just 3 months. The risk to reward is still quite beneficial in my opinion, but this might just be one that you have to DCA in the event when we start our first buys here and the sector has a bit of a retracement here back into support on ITB 100, the $100 range, or on XHB. Not too bad as well to be buying some dips and go for the expansion of the housing market theme. I don't have these personally. I'm going with Rocket Mortgage for my housing and interest rate play in the event that you wanted to play an entire sector, the home builders, which have been lagging behind the market for the better part of the last year. I know the trade, I mean, we shouted out on the channel back here, so you guys can't say I didn't kind of give you the heads up, right? But still, not a bad opportunity. But since whenever we are not getting the best entry, guys, I want you guys to focus on the DCA method. It's going to work out the best for you because once again, these plays are all like the next 6, 12, 18 months. So although you may think that you're late, you might be surprised when we start going into a bullish cycle for something, that cycle can last quite a while. And lastly, we're going to talk about some growth plays and some plays that have been left behind. Some of your favorite, well, maybe not some of your favorite, but some of the market's former favorite growth names that have been left behind. ASML, we touched about it earlier in the video today. ASML, probably one of my favorite companies with a very dominant moat, very dominant competitive advantage right now. And currently, in terms of the forward price to earnings metrics, they're very cheap, guys. Whether it's on a forward price to earnings, whether it's on a PEG ratio basis as well for 25 or 26, or whether you measure it on a free cash flow yield, this one is very strong. However, it has been left behind a little bit in relation to the rest of the semiconductor landscape. This one, it's very expensive. So a lot of you guys will not have access to leap call contracts or stuff like that. And I don't want you guys to start buying out of the money call options, 1,000, 1,100. That's not really how I do things. However, if we wanted to accumulate some shares, I think it's a very strong company that's been left behind the rest of the market. But if we see a broadening out of the market and the market starts hunting for value in names that have been left behind, we can definitely explore some MSTR. Another segment of the market that's been notoriously left behind, we've talked about it for a while, is software. Whether those are cybersecurity companies that have been down 20% in the last month, or other software plays, you might be surprised at some of the discounts that you can get. Some of the software plays that I'm exploring, if I'm looking for cybersecurity, I'm looking at SentinelOne. Why? Because number one, it's very cheap. It's easy to do call options on, and rallying from 16 back to 20 or from 16 back to 28 within the next 6 to 12 months may not be so far-fetched. Shout out though to CrowdStrike, which is a fantastic company, one of my favorite in this space, which is a very nice DCA opportunity for shares. Maybe not so much for call options because they are expensive and they do trade expensive as well, but DCAing some shares here through there might not be the worst opportunity. Just be careful on CrowdStrike because they do have earnings coming up this Wednesday. In the event they drop after earnings, well, it'll be a fantastic area. I would be looking to accumulate from here down under the $400 range. I think the growth for this company in the next 2, 3, 4 years with the rest of the cybersecurity industry could be quite advantageous. I'm not doing a big bet on SentinelOne. It's just an asymmetric call option for me. I have the $20 leap calls. You guys can see those right about there. I have a very tiny position on SentinelOne. I've always told you guys as well that in the event it drops more, I'll be accumulating a few more contracts. But as you can see, I'm going with the 2027 $20 strike, just slightly above, and probably riding this one into the expansion phase for this company. It's a good acquisition target as well, but shout out to CrowdStrike as well. Moving on to some of the other software plays that have been left behind. Salesforce. Salesforce has been an absolute disaster this year. Let's be honest. If you look at it on a year-to-date performance, it's down 25%, but not because the company has missed on execution or nothing. No, matter of fact, they've been executing well. It's just the entire software landscape has just been atrocious in the last 1 year, or rather last 9 months worth of trade. It's representing a very nice discount from its all-time highs, currently down about 32%, 25% year to date. And the valuation down here is not that bad, guys. We did it at 280. It's actually quite manageable, trading at a mid-20s price to earnings and a very decent free cash flow yield. So I'm a big fan of giving Salesforce a chance and represents a very nice swing trade opportunity too. Stops would go below this low right here. We are targeting expansion into the former slight resistance targets right there. And beyond that, we are targeting expansion of the monthly back up here to about 316, 300. It will not do it in 2 weeks. This is longer form monthly expansion, but it may just be some time to position if this is the type of company that you might be interested in. All of your software as a service applications, some of you guys like CRM, some of you guys like ServiceNow, fantastic company as well. Could be looking quite good for some expansion. As we know, since the start of the year, they just haven't really been doing so well as much as the rest of the market. So keep those in mind too. And lastly, some consumer discretionary stocks. My favorite 2 consumer discretionary stocks right now for recovery story for the next 6 to 12 months as we move into a rate cut environment that could see a broadening out of the market and consumers possibly coming back on the table into 2026. Nike. The recovery story is already underway. New CEO is currently doing a very good job of kind of rekindling what made the company once great, such as focusing on, big brand, big sponsorship deals with a lot of top athletes, sponsoring different sports networks and sports associations and things of that nature, and also coming back to the wholesale model of, partnering a lot with companies like Foot Locker and other locations where you find a lot of Nike shoes. The brand has been struggling, but does represent some pretty decent value down here. Not a bad bet at 78 if you're trying to play the recovery story of the company over the next 6, 12, 18 months. Not a bad bet in my humble opinion. I would not count Nike down and out forever. We know they've had a terrible last 2-3 years, but with the broadening out of the market, you might find a bit more institutional support coming in at these levels. Building a position between 75 and 65, not the worst opportunity. And the other segment of the market, which is luxury goods. Luxury goods have been somewhat struggling here in the same amount of time, right? Since late 2022, for the past 2 years, these have been nothing but down and down and down and down, right? Not so much because of financing, but also just because people are a bit more stringent on their budgets. If that frees up with the tax cuts that are coming, with the interest rates that are coming as well, and an overall better economic perception that might make its way into the market over the next 6, 12, 18 months, Louis Vuitton, fantastic companies, fantastic company, guys. You know that by now. I'll try and cover their earnings soon if I can, but this one, guys, is trading really at some historical low levels right now. The forward price to earnings is low 20s. It pays a 2% dividend yield. And take a look here, guys, in terms of the forward growth prospects for the company, it's a cyclical company, right? It ebbs and flows with the economy, but the forecast, the cycle bottom is probably here in terms of EPS. Analysts and the company are forecasting a return to growth over the next 12, 18 months, not only on EPS, but also in terms of revenue as well. We've kind of hit the trough of cyclicality right now. And the share price, right? The share price has been absolutely crushed. I'm a big fan of positioning in Louis Vuitton at these lower levels. You might just be surprised at the size of the move that this one can do in a bullish consumer environment. It tends to do very well. This is one of the worst performing periods of the stock, arguably in the last 10 years. So I want to take advantage of this one, but also not a very fast mover, but an interesting position to build over the next coming weeks, over the next coming months, and going for that longer duration expansion. So that being said, that's everything I had for you guys for the ideas, right? Obviously, we went over all the big tech names. Last week, we did a good job of going over everybody's favorite growth names, such as, Palantir, Robinhood, all the other classic growth names. And you guys know we covered a lot of them. I'll be covering more of them on a recurring basis on the daily, right? After the daily recap videos towards the end when we go through the biggest gainers and losers. But some of these companies I talked about today, I haven't talked about in a while, right? So hopefully today, hopefully it gave you some perspectives, or maybe when I mentioned a name, maybe it made you think of another name that you haven't thought of in a long time. So let me know if you guys appreciated that segment. And now let's do a quick review of my portfolio to see how we ended the week. So in terms of the trades made this week, it was a bit of a light week for me because I was kind of out of buying power. I was assigned a lot of positions, but now we have full buying power. We were called away on a few plays. You can see here that the wheel trades that we took this week, very light, but we did take a few BITX, SOXL, and new holdings. Those were also available on the top 5 options plays video last Sunday. So hopefully you guys are able to get a piece of this. But even when I am not participating directly in trades, I am giving direct trade ideas to our members. In this little trade ideas section, there was a lot of trades this week, especially on Tuesday and Wednesday. So hopefully you guys were able to get inspired from last week's top 5 options videos, because almost all of them were available, but I was only able to take a few just because of I didn't have that much buying power. But now I do. Some of the positions that we were called away on, we got called away on Amazon. In the past 3 weeks, we've made about 3%, all said and done. We got assigned the shares. We were able to do some covered calls. We got called away. We made about 3%, $6.64 per share. Chewy, also a play that we got assigned a few weeks ago here. We were in this one for 4 weeks, 2.1%. Keep in mind, my target is 0.5% per week. So Amazon respected that minimum. Chewy respected that minimum as well for 0.5% per week. And Open Door, you might remember I had a tiny position on Open Door. We sold 100 of our 200 shares at about $2.50. Our average cost was $2.35. That's about 6% in 4 weeks. But I do have more Open Door shares. This most recent batch of Open Door shares, we have a $4 covered call on it. And if we do get filled on that, our current cost basis of Open Door with the new covered calls at $4, we're looking pretty good here. Open Door. This next cost basis is $1.93. So if I get called away at $4, it's going to be like a 2x. Now, I might be getting back in using more short puts and trying to play the next stage of the rally, but this is a very small position for me, very speculative bet as well, right? Moving on further, we did lose on one, Fiserv right here. We got called away at 130. We got assigned at 146 after earnings. Once again, this is why I tell you guys not to play earnings. You might see me doing it sometimes and assuming that risk, but this was a 4 standard deviation move. We were assigned at 146 after earnings, and obviously it went way below that. So we tried to farm some covered calls at the top, and then as the stock moved down, we followed the covered calls, before which I put an end to the trade, and I did some defensive covered calls at the lows right here at 130. You might be wondering, why didn't you just wait till it popped higher to write covered calls? Good question. That's because we're in the middle of nowhere, guys, right? We're literally between resistance and support. So what I did not want to do is run the risk of being uncovered down to the logical support range, which is about 125 down to about 115, into fall seasonality, into an uncertain Fed as well, because this one is also beholden to the direction of interest rates. So I did not want to hold this one uncovered. I put a stop. I basically capped the loss. We were able to reduce our average cost basis from 146 to about 138.12 with the covered calls, which resulted in a $8.12 loss per share. I might revisit Fiserv for a share replacement strategy because we know that holding 100 shares is not the most efficient use of capital. If I had to position myself in Fiserv again, what you might see in the near-term future is possibly going for some leap call options, because it's going to be cheaper for me to hold a leap than it would be holding 100 shares for the appreciation. And if I'm using the wheel is not meant for offense, guys. Leap call options are used for offense. So you might see me do a 70 delta, which would be about $3,000. I'd rather put $3,000 in Fiserv for the next year and a half and go for the big expansion rather than being stuck with $14,000 worth of shares. And I'd rather just replace that with something that's not in the middle of nowhere, right? If it comes back down to 125, you will see me playing the wheel again. I just didn't want to take an uncovered thing, and I offset that loss with the Open, the Chewy, and the Amazon profits. So sadly, a bit of a wash, but you'll notice a common theme here, guys. This is why I tell you guys not to play earnings. You might see me do it because I assume the higher risk, but you don't actually have to play earnings. If you look at all the wheel trades, this trade on Walmart, by the way, that we closed, we opened it last Thursday, not this past Thursday, a week before, in preparation after the Amazon news, essentially, when it dropped right here, right? It dropped right here. This is the time that I opened the Walmart 97s. I was hoping for a bounce into earnings. It didn't come, but it did come early, or rather, early over the course of this week. So what I chose to do, rather than sitting in it for earnings, as you can see, if I would have held that 97, I would have been assigned. It closed below 97 on the Friday session. Not the worst strike, but I would much prefer playing it down here into support. So I was trying to play a short-term put, get a bounce before earnings, and get out before earnings. I chose to wind it down on the Monday session just as a pre-earnings risk management trade, right? We lost a whole $7 on this trade, guys. So we really limited the loss, just proper risk management, in my opinion. But it just goes to show, guys, that earnings are a toss-up. If you take a look at most of the wheel trades here of the past several months, just look at the wheel trade section, great. But then see, one big loss on earnings like Trade Desk can erase a lot of the prior nice earnings trade that you do. But when you just run the normal wheel, right, just the normal wheel, the success rate is very high, provided that you're respecting all the strategy rules. And one of the strategy rules is not playing earnings. So don't do what I do. Do what I say, essentially. You don't need to play earnings. I do it because I try to grow the account a little bit faster. But if you're not careful on your earnings plays, you can end up taking some losses such as this, that with stocks that end up kind of in the middle of nowhere after earnings, with an unclear, or rather a big distance between the next support level and, the fact that we're still right now in weekly downtrending territory. So that being said, that's the recap on Fiserv and why I closed it. I'll just reallocate the capital to something else. But these three plays, even Amazon was a trade we got assigned after earnings, right? The Chewies and the Open Doors, those are not after earnings. Those are just normal strategy. Most of all the assignments that we get called away, I have an assignment tracker here. The only stocks that I've had to cut for a loss running the wheel have all been earnings trades in the last year. I've showed them all to you guys on the channel, so you guys are familiar with that. So if you don't want to end up with these very volatile positions that you may end up having to close at a loss to minimize the risk, then just don't play earnings. You can perfectly well play Fiserv after earnings as well. Matter of fact, many of my Discord members did not play earnings with me because I always label them as lottery trades. They played them after earnings, and they've been farming this lower area every time they can, and they have not been assigned, right? So that's just a quick little tidbit for you guys, but I'm always honest to you guys with all the positions, right? Sentinel-1, we rolled some covered calls into earnings next week. This one we got assigned 2 weeks ago. So we're holding into earnings, very small position, 100 shares. My average cost basis right now on Sentinel-1 is about $16.45. So I do have some wiggle room to the downside. As I've been saying on this one, if we move lower, I will DCA this trade. Very logical trade in terms of a massive support area for the past 2 years. So I do not mind buying 100 extra shares. In the event we drop, I will write another contract and just DCA this trade. And last but not least, we got assigned a new position, CoreWeave. So CoreWeave is a bit of a tricky one. CoreWeave, we had this one into last Friday, not this Friday that just came, the Friday before, after their earnings. After they came out with earnings and dropped 20% on that day, I wrote the 110 short puts into the support range. When it moved down even lower, the Friday session right after Thursday, I rolled this one down for a credit from 111 down to 101. So I was able to save $10 on the share price. Sadly, it was not enough. We did get assigned this most recent Friday. Our cost basis on those CoreWeave shares is right here. Our cost basis now is 99.72. So we are underwater, and you will see me farming this one with covered calls to the upside. And in the event we come back down sub 80, I'll be adding another position. But this is a trade that I did wait for after earnings. However, I was just a little bit too close for the market's liking, and as a result, I did get assigned. But I'm very bullish on this position. Sentiment has kind of been atrocious, and we've made so much money on CoreWeave farming these declines. Out of maybe the 20 trades that I've done on CoreWeave in the past 2 months, this is the first one that we got assigned. So on CoreWeave as a stock overall, I'm still well profitable, even though this position is not right now. And the covered calls on this one for the upcoming week are extremely juicy. So I'll be targeting my assigned strike price of 101 and just going with covered calls on a week-to-week basis. And we will see how this trade plays out. I'm still very bullish on the company. Those are all the trades that we kind of closed out in the Discord throughout the week. There were many more for our other members. Those are the ones that I took personally. Now, in terms of where we stand after Friday, guys, don't pay attention to this $300 loss. We were actually up like $2,000 on this portfolio on Friday. For some which reason, Interactive Brokers just like resets the bid and ask spreads across a lot of these contracts. But you can see like the profits that we made on Friday across a lot of these things are quite substantial. Plus all the profits from the stuff that got called away. Overall, excess gains from Thursday to Friday was about 2,000, about 4.5% on this portfolio right here. So we had a good day. So this number is kind of an outlier right here. It shouldn't be accurate. We'll see how it updates on Monday. Right now, what we currently still have, of course, is the assigned shares of CoreWeave, which you just went over, the slight position in Duolingo, which I started, which I will be DCing into in the event that Duolingo falls a little bit more. Duolingo for me is a longer duration swing trade. So if I'm going to price this one out, this is like a 12 to 18 month swing trade. Here's my first DCA. This is where more DCA shares come into play, but it's just a longer form swing trade. I'm doing another one in another portfolio on CoreWeave, on Circle, and on MSTR as well. You guys can see those trades right here in this section where I've been buying into Circle and MSTR $1,000 at a time. I've been starting to do that here, guys, over the past 1 to 2 weeks as these stocks have fallen, and I do believe they'll have some good expansion possibilities in the next 6 to 12 months, but those are just shares, and I keep those shares in my tax-free account. So that way, when I sell them, I don't have to pay taxes. So I'm kind of using another account to build all the other positions. But Duolingo is in this account right here. We will accumulate that position. Restoration Hardware. These are the 4 shares that I've been holding for the past 6 months. Same thesis. Furniture, interest rates. So I'm just looking for a maybe 50%, 2x over the next 6-12 months on registration hardware. We'll see what happens. Long options and the combo trades debit spreads, they have not changed at all. We still have the Affirm calls, which you guys are familiar with, going for the expansion. Still have the K-Web calls, which we've had for a while, going for the expansion. Those are up 41%. Still have the new Oscar and Sentinel-1 small call options that I started in the last 2 weeks. Those are now up decently, but we'll see what happens. Right? Oscar Health, I'll remind you, you guys know the Sentinel-1 trade. Oscar Health is just an easy play. We bought these into support, 2 years worth of support to be exact, and we are going for the expansion. This is a healthcare insurance play. I'm going with the fastest horse in the race. Yes, UNH is good. Yes, other companies can be good, but what company can possibly move up the fastest? I think it's going to be Oscar Health, and as a result, that's the one that I'm playing with some calls. Moving into TLT, this has been a hedge in the portfolio for the past 9 months. Still haven't added to it just yet. I'm very, very close to adding to this one. January 2027, $80 calls. We'll see what happens. And healthcare. You guys might remember that my first foray into these healthcare leaps was on June the 2nd. June the 2nd is the first time I started a position here. The second call option came down here. Now we are ready to ride. That is pretty much the amount of money that I wanted to allocate to healthcare. These healthcare calls are up about 24% right now. And we have until January 2027. In terms of the short puts that we have open, well, the covered calls on Sentinel-1 and Open Door we already talked about. The only position for the wheel that I have into next week is BMNR, Tom Lee's ETF, right? And as a result, well, not an ETF, but it's really a fund, right? BMNR, I tell you guys, don't play this one too close. You can get fantastic premiums going way, 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 way below the market. And BMNR is, for me, a buy in the lower $40 range into the 30s as well. As a result, I will play some short puts down there, provided they continue to offer me some good premium. And on the Friday session, right after Jerome Powell gave his speech, I was able to get 67 cents for the 42 puts, and now those are currently profitable. That's the only wheel position that I have. The other plays, we've been through them many times. No new plays right here. The leaps, we'll go over those first. The Amazon leap that we have, spread, December 2027, 42% up right now. The Google leap call spread that we started when Google was 165, good for June 2027, that is 70% up right now. The Micron that we started right after the tariff pause back in April, this one is currently up 134%, and I will be holding this one going for 150, 160, 170. Those are the larger spreads. Other little spreads that we have, some are doing okay, some still have to come back a little bit. Airbnb and PayPal are the two newest ones, which we started just last week. PayPal is roughly break even, and Airbnb is now currently profitable by about 31%, coming into our profit target 130. Airbnb and PayPal, very simple. What we're looking to go for here, we were looking for the earnings flush into support. We build a position down here, and we're looking just for the recapture into the next resistance range. So a bit of a swing trade long, and we're coming into the profit target right now. PayPal is the exact same trade, playing the earnings flush into support and just looking for a bit of the long expansion trade back into the low $70 range. Those are the two newest swing trades. The other ones you guys are familiar with, Adobe and CRM, and ASML and Berkshire, looking for the recovery of those companies. I've been in those for a while, probably about a month. So as a result, the past month has not been the best for them. They're trying to bottom. This ASML trade was profitable into earnings. They unwound after earnings. We went into a loss on this one, but we're only down about 28% on ASML. CRM is still down 70%. I still have not DCA'd this trade. I have until October. I might be doing that this week. CRM, we're basically just looking for, as I was kind of describing, guys, we're looking for the bottoming out process into the highs. I played the early test and a support going for this. It might just be time for me to DCA and target this area for an overall exit of this trade. And ASML, same concept. We're just going for a bit higher. We already DCA'd this trade, and that's pretty much it. Berkshire, you guys know the drill already with Berkshire. I mean, Berkshire, we entered this one early. It took a bath a bit after earnings. We entered this one back here. It continued to slide, slide, slide. Now it's kind of working in our favor. All of these trades are dated for at least October and November, so I'm not too worried. I still got a lot of time on these trades, but you can see there's not that many short-term directional plays. All the other super bullish ones, we already closed leading into the month of August. These are just the remaining ones. And as you see, I still do have a nice amount of time on all of those. So that is the entire portfolio landscape. And yes, I do have a tremendous amount of buying power to go shopping for more wheel contracts over the course of the next week. So looking forward to that. That is everything I had to show for you guys today. In the event that you guys enjoyed today's video, consider dropping a like. I would really appreciate it for the channel's growth. Consider subscribing as well. We do these videos every Monday to Friday after the close, except when I do them on Saturday because I'm busy on Friday nights. And last but not least, if you have any questions, please leave them down below in the comment section. I'll be answering all of the comments tonight. All the comments left on the Wednesday and Thursday videos. Sorry, I didn't have time to get around to them. I'll definitely answer all of them tonight. And in the event that you guys wanted to participate in a trading and investing community that focuses on trading the markets every day, but in a very somewhat conservative fashion, like no day trades, guys. A lot of these are just longer dated swing trades, longer dated call options, swing trades with shares, building long-term positions as well, and running the wheel strategy. You may consider joining our trading and investing community with over 200 other members that are trading the markets in a like-minded fashion, right? In that Discord, of course, you get access to all of my swing trades, all of my trades, whether it's the wheel trades, whether it's the directional bets like call options, leap call options, swing trades with shares, and everything in that nature. Here are all the trades that we've made over the course of the past 2-3 months at this point. The red little circles are losses. The green little check marks are wins. So there you have it. You get access to those. You also get access to our private morning live streams Monday through Friday, where I stream in the morning for about 2 to 3 hours. I trade the markets live, but I also answer all your questions on your stocks, your options, and your long-term portfolios. So in the event you wanted to get closer access one-on-one to me, with me, and ask me all of your burning questions on your stocks, your options, your long-term portfolios, it's a good place to do it. If you can't be there, you can do that in our main chat rooms. You also get access to our private video section where I go over options trading strategies, how to grow small, medium, large accounts as well, and technical analysis, fundamental analysis, all the educational stuff that I don't show so much on YouTube. It's all available in the Discord. And lastly, you get to copy paste all my watch lists and all my charts as an added bonus. If any of that interests you, the link to the Discord is down below. Hopefully I see you in there soon. And if not, I'll see you right back here on the channel. Take care. See you tomorrow. That's it for me. Peace.